Aloha, everyone. Joshua Hayes at Big Wave Trading.com. It's been a couple of weeks since a video lesson, and the market's finally doing a little bit of shimmy, shimmy, shake, shake. So let's go ahead and do a recap of where we stand in the market right now. What I want to do, though, first is start with a weekly time frame. And just to show everybody, I kind of keep it simple. On a weekly basis, I don't get bearish and think that, oh, that's it, there's a new bear market until we're below a 200 weekly moving average. And once we are, I blew this, guys. My personal trading methodology, I screwed this up. I should have been focusing on the leaders with strong accumulation distribution lines, which is that lower line there. Strong relative price strength, stocks holding up near the highs. For instance, one of my favorite long-term stocks, AMD, on a weekly basis, it only got down to the 50 weekly moving average, and on a daily basis, this thing didn't even get below its 200-day moving average. Should have done that, okay? So I admit that I've made mistakes, and I was slow at reacting off the lows. I really thought we were going to retest the lows. But the one thing I definitely didn't do, you didn't see me going everywhere screaming that this is a new bear market. Why? Because long term, we can use multiple examples here because I've lived through both of these. So you'll see here, once we got below the 200 weekly moving average, we try to rally back above it, but then we roll back below it. It's that retest of the 200 weekly moving average and roll back below that should be of concern. You can see it happen here in 2008 too. We flirt with it here. We get below the 200 weekly average. We hit it here and we roll over. Bear market. So anybody that's talking about this turning into a bear market here, awesome. If you can predict the future, I cannot predict the future. I can just tell you what I've used. And there's only been 2 market periods in my investing career that's actually been a real bear market. And that's been these 2 years. And as you can see, they clearly coincide with the 200 weekly moving average. You can see that there on the SPY. This is the DIA. This is the QQQ. This is the IWM. We don't have that right now. And what we saw here, we tried to flirt with the failure here on the IWM, but now we're back above the 200 weekly moving average and we're finding support there. But if you look at all the other moving averages, not only are they above the 200 on the weekly, but this blue line here, sorry for all this, guys. I know it probably looks a little, and oh my God, look at all these histograms and lines, but I know what they are, so I'm going to try to keep it simple for each of these little lessons that we're going over. Focus on this yellow line here and this blue line here on these weekly charts, which is what we're looking at. QQQ is above both of them. SPY is above both of them, even the 50 and the 100 weekly moving average. This purple line's the 100. So 50, 100, 200. These are the ones I look at on a weekly time frame to tell me how the market looks overall. When we look at all of these averages, we can see the same thing in every single one, no matter which one we look at. The IWM is the only one that's a little weird, but it is above this yellow line, which is kind of being covered up by this 34 EMA. And it's above the 100 and the 200, the 200s here, the 150 are, kind of all in here. But every index is above those longer term moving averages. So on a weekly basis, we are good. This is just a correction. Now, how do we look on an intermediate term time frame? So for an intermediate term time frame, I go down to the daily and I always look where are we at in relation to basically the 50, 100, and 200 there. If we look at the IWM, we're above the 100 and 200 here, and we're actually above the 50, and this is one of the best looking index right now. And as you can see, the volatility stop has even switched and is now below price. So that's actually something that I'm just now noticing on this chart. So that's very, very good. And it's in a squeeze. But it's a loose squeeze. That's what these gray dots are right there. But you can see we're above all those time frames. Hard for me to be too bearish when that's the case. Could all this change? Absolutely. But it hasn't changed yet. And I work with what's going on in the market right now. The QQQ, it is below its 50. That is a concern, but it's above its 100 and 200 on the daily. The SPY, same thing. Minor concern here. Still above the longer term moving averages. Everything looks fine to me. The DIA is not only still above its 50, but it hasn't even violated these September lows. Now, earlier, the QQQ tried to do an undercut and rally, but I warned everybody at BigWaveTrading.com that this undercut and rally was not good because you didn't see a big flush, a big tail at the bottom, and this closed bar, the body of this bar, this is the open, this is the close. A good undercut and rally candle would look like this. You would have a hollow body to it. You don't have that there. You didn't have those in any of the indices, the SPY or the QQQ that tried it. Friday is not an undercut and rally because of where we closed. So far, you know, a little bit of weakness. Volatility stop is above the SPY, above the QQQ, and above the DIA, but the IWM, so far so good, and even the DIA is above its 50-day moving average. So we're kind of mixed there. We're mixed there, but overall, if we're looking at the 100 and 200, we are good there also. Now on the shortest term time frame, if we look at the most short-term time frames, we still have to be cautious. Let me go ahead and remove that thick line right there. I know it's kind of hard to see, but trust me on this. This yellow line right here is the 5 exponential moving averages. I use a series of moving averages using the Fibonacci sequence, the 5, the 8, the 13, which is not shown on this chart, but here you can see it right here, the EVA 13, the 21, 34, and then instead of the 55 EMA and the 89 EMA, I loosen that out, use the 50, 100, 200 simple moving averages. But the 5 EMA, to be bullish on the most shortest to short-term time frames, you want to see price above the 5 EMA. We do not have that here on the DIA. We do not have that here on the SPY, QQQ, the IWM. I think, let's see, the EVA 5 is 153.30. The IWM is even below it by 1 cent. So all of the indices on the most shortest moving, based on the most shortest moving averages, are still below the 5 EMA. And if that's the case on the most shortest short-term time frame, you have to be cautious. Now, let's even get a little bit more granular by going to the hourly time frame. Now, when it comes to the hourly time frame, the two lines that I pay attention to signal a real reversal off the highs is the anchored VWAP to the highs and the 50 hourly simple moving average. Now we'll look at the IWM first, and if you look at the IWM, it's hard to see because the blue line is kind of matching up with the anchored VWAP, but we are actually above it. So on the most shortest granular time frame that I look at for the market outside of day trading, we go below the hourly. Longer term, it's hourly and above. IWM is actually in a good position. It's not great, but it is in a good position. So let's keep that in mind there. When we look at the QQQ, we can see we're clearly below this thick anchored VWAP line, and we're below this blue 50 simple moving average, and they're both trending lower. So on the most shortest of short-term time frames, we got to think the market is going to continue to pull back. You can see on the SPY, the thick line right here, that's the anchored VWAP off the highs, and the 50 SMA. We're below that. So short term, we have to think that there's further to go here. Could reverse at any time, but you can't really get bullish again until this line is above this line. And then there's one more data point I want to go over with the moving averages that I forgot to go over. Let's go ahead and get rid of this line here. This green line is the 8 EMA. This light blue line is the 21 EMA. Since this turn higher here, right here, this line has not crossed below the 21 EMA. The last time that happened was up here, right here. We cross below and we puke. Doesn't mean it's going to happen, but I always want to see the 8 above the 21 EMA. So when I see this green line, you can barely see it on this chart, and I apologize, just trust me. The 8 EMA, I use the 9 EMA intraday on the 3 and 1 minute chart. The 8 EMA is below the 21 EMA on the DIA, the SPY, you can clearly see it. The QQQ, you can clearly see it. And the IWM, boy, I can barely even see it. I have to go over here. The 8's at 153.21. The 21 EMA is at 153.48. So also the 8 is below the 21 on the IWM. So after we just looked at all of that, what is my synopsis regarding the market? Simple. QQQ, longer term, we're great. I want to be a buyer of dips. But short term, we have more added pressure. This upcoming trading week is the third worst week for stock market returns historically, going back in a 5-day period from Monday to Friday, going back to 1950. The only two worst weeks, the worst week is coming in October. The second worst week is back in July. Can't remember which weeks. I think it's the second week of October. July, I've already forgotten. But September, this upcoming week, third worst week. So we got to think short term. We're still under a lot of pressure, but as long as we stay above these longer term, we're good. So overall, we got to be cautious, but there's reasons to be bullish, and we'll go over that here in a minute. But SPY, QQQ, DIA, short term, I'm worried that the pullback could pull in further, but overall, it's a buying opportunity in my opinion. I'm still bullish longer term, secular term. Think of those weekly charts. Think of that 100, 200 simple moving average. That's why. And then whenever we look at the IWM, yeah, I mean, the 8 and 21's not good. It's below the 5 EMA, but you know what? We're above the volatility stop. We held up really well. I'm more bullish on this index than I am all the others. And that's amazing because this index has lagged since the 2018 highs. It's been absolutely pathetic as the big caps have led. So before I move on, I also want to make mention that my personal trading, the way that I trade, always does the best when the VIX is below, I can't get it to snap, but we'll just use that line as a guide. 20, 30, can I get it to near 30? I can't. So let's just do that. Okay, that's good. So my personal trading methodology, whenever I'm trading my best on an intermediate term time frame, comes whenever the VIX is below this white line. So 2003 to 2007, no surprise, I did very well. Didn't start trading until 1998, 1999, but even then it was in between this 30 and 20 range. It chopped around a lot, and it spent a lot of time near 20, but that was a hot market. My charts were great and hot. They're no longer great and hot. It's harder for me to differentiate between a great signal and a good signal. It's sloppy right now on an end-of-day trend following basis, but this is whenever I really shine in my methodology. It's whenever you see this VIX continuously stay below this 20 line. And even though 2019 wasn't great because I didn't get a lot of great signals, it's no surprise that I did well relative to the market because it's below this line. It's now also, in hindsight, as it was happening, I couldn't quite figure out why can I not keep pace with this market. I can't day trade. I'm on Maui. I could if I committed full time to day trading, but with the end of day stuff, with the time frame, the hourly difference between New York and Maui, it's been very difficult. I'll do it eventually in the future. I can see day trading full time in my future because I know what I'm doing. Just ask anybody that's in the chat room with me. The alerts I put out every morning, they're solid. Just can't do it on my end, especially with all the end-of-day work. But it's no surprise with us above the 20 line that my end-of-day trend following swing trading methodology, including the lack of great signals, is kind of underperformed. Once we're below 20, that's when we start hitting winners. So like I posted 3 on social media, like TUP is up 85% in a month, 1 1/4 months. IESC is up 20% in a month, for instance. And the one that I really want to go over, Workhorse, is up 86% in about 1.5 months. Those returns, you can double, triple them during that time frame when we're back below 20. So just keep that in mind on the other end. The other data point I want to show you, obviously, is the one data point that I always love to review, and that is the monthly time segment volume. We'll use the trading view charts because it kind of shows the background color. But you can see, ever since the SPY transition from September 2018 to October 2018, this has been ugly. And this red line is the moving average line. It's still downtrending. So even though we had a blip of green from the month of June to July into August, the moving average line kept trending lower. Now, it's always a good time to start in there, but really great things happen and have always happened when my monthly, look at the 90s, look at this. It's always come when this background color is green, the signal line is above the moving average line, and it's just trending higher. You can see that here in the 2003 period, the 2009 period, and even most recently in the 2017 period. We still don't have that. And that's why probably in 2019, I didn't get a whole lot of, I did get some, but I didn't get a lot, and they weren't clear, amazing long signals in an intermediate time frame. Should have focused on the cancel quality names, the best of the best, the earnings winners, the stocks that are beating on the top and bottom line, stocks that I love like AMD, Apple, Zoom, Tesla, stuff like that. Yeah, hindsight, 2020. But the bottom line is, no wonder this is trending lower. But you can see that same case on the DIA. The only index that has not been happening is the QQQ, and you can see even then it's starting to tighten again. Now the moving average line has curled higher. That is awesome. Good. Step one in one index, but the rest of the indices still very bad. Now the IWM, you can see it turning green here, but remember, this is the month's not closed yet, and even if it does close, the moving average line, if you go over here and look in this box here, you can see the numbers. The moving average line is still getting smaller and smaller, so it's still declining. It is not rising. When it rises, you can see the number in the red going higher, but as you can see here, it's still going lower. So we're still trending lower. The TSV has not changed on a monthly time frame, and until it does, it's very hard to get good positions. And that then is why, with me lagging on an intermediate time frame and unable to day trade, before we move on to this next segment, I want to discuss my model charts. Excuse me, I apologize, model portfolios. So I've been working on a longer-term methodology, introduced it this quarter, but I've been back testing it for a while, and its outperformance showed up this week. So despite what the market did this week, you can clearly see that the stock market on the week, it fell 0.64%. But the model portfolio, an aggressive portfolio I run, which basically you take 10 stocks, you buy 10% of your capital into each of these, you hold them for 90 days, and in 90 days, we replace them with the 10 best stocks and 10 best industry groups. We hold them for a quarter. You rotate that each quarter, but you hold each of these 10 stocks for 90 days. That way you don't, if you can't day trade, okay, can't day trade. Now, if you don't like my end-of-day swing trading trend following because it's just not producing the kind of returns, there's a lot more misses than hits, which means you got to cut your losses. You got to do more active managing. Fine. Then we have these portfolios. Now, just to let you know, the S&P 500 was down 0.64% on the week. My model portfolio was up 3.54%. The aggressive portfolio was up 3.8%. And then I have another strong accumulation distribution portfolio that I track. And that's these stocks up here. I might as well just give them to everybody for free here. You can see them here because it's not a portfolio that I'm actively managing, I guess you could say right now. That was up 4% for the week. So quite impressive. And just so you know, since this quarter when I introduced it, it's been okay for one of the portfolios. It's the model one. It's up 1.69% versus S&P being down 1.64%. But the aggressive one, SP's down negative 1.64, but in full disclosure, it is down negative 8.72% this week, or since this quarter began, and I started that sometime around August 15th, right around there. Since inception, this model portfolio, since I started backtrack it, going back to when my underperformance on a trend following basis started, is up 131% according to my Excel spreadsheet, compared to the stock market being up 24%, the S&P 500. The aggressive portfolio, which I back tested only back to May of 2019, is up 34%, while the S&P 500 is only up 16%. So the aggressive portfolio is doubling the returns of the S&P 500 in that period of time, and the model portfolio almost is beating it by 5 times. So there's a 5 times, almost a 6 times return on the model portfolio compared to the overall market. I bring all this up because my preferred time for trading right now, time frame, remains intraday. If you can day trade, I tell you what, every day, we call them out every morning in the chat room. We alert them every single day. The top stocks that are setting up based on relative volume, gaps, whatever, I know what I'm looking for. I just don't have the time to day trade them right now. But they are just, it's the safest time frame. You're out by the end of the day. There's no gap downs. There's no one to worry about the market reversals. That remains my preferred time frame. But if you can't day trade, that's what these model portfolios are. And then that's where this end-of-day trend following methodology comes into. So I just want to wrap up this video lesson, show you 2 stocks, one that I went long and one that I didn't, and what we can learn from them. So the first stock is WKHS. This was my first long signal on the stock right here. This is what I got. Got an engulfing candle over candle, hammer candle off price support, heavier above average volume, and look at all of this green balance of power. I'd like to see that. That was the signal. That signal did not trigger by trading up and through the high of the day until 7:30. So this was my first entry into WKHS. Now, remember what I showed you about the VIX, the monthly TSV? I do believe, without a doubt, in a better market, I would have established a very large position in this name because there's multiple add days that I did not add to it, that I'm sure that if this would have been any other market environment where things are lined up, VIX under 20, monthly TSV, we're really building a huge position in this. So WKHS finally takes off this day, but starts to pull back. This is technically another actionable signal right here, but because balance of power did not go green, I didn't buy it. Now in a better market, this is another add signal. Then there's this session here. Once again, any other market environment, I'm sure this BOP is green, and volume should be above average. Notice on both of these days it was below average. This would have been another add signal. Then you get this day. Do you see how we actually now have the green BOP, the heavier volume, but we close off the high of the day? So I didn't add to it, but that would have been another add signal. Finally, I get a legit add signal, candle over candle, pocket pivot, above average volume, BOP goes to max green, and I add to WKHS. A couple of sessions later, I get the best add signal, and this was the best signal. That BOP, that pocket pivot point signal, but what is it missing? That volume surge. If volume would have been bigger here, definitely would have taken a bigger size, but WKHS has worked perfectly since then. This would have been, we would have gotten 1, 2, 3, 4, 5. That would have been a 6 add signal. Even if you do 1 R risk per each trade, you at least have 6 Rs in this trade. Since that signal, it's up 87% in 1.5 months. Now, I want to also show you what it looked like on Telechart version 18 because it's very important. I confirm everything like this. And why I bring this up is because a lot of people say, Josh, your watch list sometimes has too many names. This weekend, because of quad witching, that happened. I got 13 freaking actionable signals. I'm willing to take all 13. Normally, I risk 1 R per trade, but right now, I'm trading like a piker with my methodology because right now things aren't lined up. I'm willing to take all 13. However, in my video lesson for members this weekend, I showed them how to take those 13 and start whittling it down to the best of the best. Now, like I said, you can put 100% of your account into one of these signals. You can split it all up. You can put 1% of your account in each signal. Everybody's different. You can put 10% in signal, pick 10, put 10% in, you're fully invested. What works, works. What doesn't, you cut your losses. We always cut our losses. But the thing is, I showed them how to take these 13. We then, after our very first go through, whittled it down to 9. Then we put it under another test and whittled those 9 down to 3. And we put those 3 through a final test. By the final test, 0. So if you're looking for the best of the best long signals where everything is lined up perfectly, I have 0 new long signals on my watch list for Monday. But instead, if you loosen it up and you use the proper reward risk ratio, which I'm always looking for 4-to-1 based on previous measure move to inherent risk, I'm always expecting to get at least half of that 4-to-1 to maintain at least a 2-to-1 risk reward. I'll try all 13. What fills, fills. What doesn't, doesn't. What fills and fails, fails. I'll cut my losses. What fills and works, great. What doesn't fill and works pisses me off, like AMK or is that the right one? No, AKMR. No, AMRK. That's it. That's the one I didn't get filled on. Long signal right here. Triggers, does not fill. And of course, the stock is up 38% in a short amount of time. That pisses me off. But still, the whole point is, there's good signals and there's not good signals. WKHS, when it was finally giving these add signals, this is a great signal. Why? The volatility stop is below price. The 8 is above the 21, is above the 34. We had a very long medium squeeze. where the TTM momentum histogram was flat. Everything was looking good in all these other lines. We then come out of this long squeeze to a loose squeeze. TTM histogram pointing up. Chaikin money flow accumulation distribution is good. Everything's lined up, and WKHS worked beautifully. That's the one that worked. Now I want to review why I need to focus more on setups that look like this, where price is like this, the squeeze is like this, because there is a stock that didn't set up and I didn't go long that we love at Big Wave Trading. DraftKings. DraftKings was brought up to my attention by members in my chat room back here. And obviously it hits my scanners too. But there were people in my chat room that loved this name when it was DEAC, before it became DraftKings here. Fast forward to where we're at now, this is what DraftKings is at now. Amazing. But when DraftKings was basing here, this is the chart I look at. This chart to me is not good enough. Look at all this red here. Look at this red. Look at these tall distribution bars. What I failed to realize is that those tall distribution bars on the daily, on a weekly, had big wicks to them. But with all this red, I automatically poo-poo it. Plus, I look at its consolidation, and it looks wide and choppy to me. So I've never really, was focused on this name, even though every day that it would pop, we were focused on it intraday. I just constantly kind of shunned it because of how volatile it was on this chart period. And unfortunately, it's cost me, because DKNG, obviously, even if you chase it up here, which is ridiculous, but let's say you get it here, it's up 50% in a short period of time, and it's one of my favorites. So I'm like, well, shit, what did it look like on this chart? And this is where the lesson can be learned, and I have to learn to focus more. So DKNG had it too. I mean, volatility stop is below price. 8's above the 21, it's above the 34 EMA. We have that long medium squeeze. Accumulation distribution's good. Chaikin's above the 0 line. These look good. Sure does look more tight on this chart than the other one, right? This is your entry point. That reversal hammer candle through all these moving averages, reclaiming all of them with the heavier volume while it's in a medium squeeze. Should have gotten long, DKNG. It's all hindsight, but this chart, proves that it's these kind of setups that in the future I got to focus more on. But it's pretty amazing how well WKHS worked and DKNG worked, both similar chart patterns. But notice how I only am involved in one of these two, and the one that I'm involved with, I have piker size compared to what I should have. But, these are things that we're adapting to as we move forward. But I just wanted to show you DKNG, how I missed that one, how I don't plan on missing it in the future, and how I'm asking all members in my chat room to please alert me to this. Even if you're a gold member, please post in the comment section, hey, dummy, the chart that we keep talking about intraday every day that we like based on its fundamentals. Another thing about DKNG, think of all the bad COVID-19 sports news that came out during this entire time, and it just kept consolidating. It never rolled over. It never sold off on huge distribution. It just held in there. So, things to work on in the future. All right, everybody, long video lesson. But hey, I don't know when I'm going to be able to make another one. Hopefully it's next week, but you just never know. This tape's very busy. It's taken me a lot of times. I have other commitments. Maui's still closed down, still helping out a lot of people around here. As soon as Maui opens up and things return to normal, hopefully I can get back to making these public video lessons every weekend. But for now, who knows when the next one's out. So I figured might as well make a long and good one. Anyway, I know it was a long video lesson. Thank you for watching. Apologize for it being so long, but hopefully you learned something. If you did, give me a thumbs up. Leave comments. If you have any questions or concerns, leave them also. Hit the bell. Subscribe if you haven't, so you can at least be notified when the next video lesson comes up. And I'll talk to everybody later. Sorry for interrupting your football Sunday. It is nice to at least have some football back. Aloha.